Friends, I welcome you all to our today's session. Previous session, I had given you a brief introduction about income tax. We are talking about scheme of taxation, how tax is levied in our country. We have tried to understand that to a large extent. And what we have understood that every person whose total income of the previous year exceeds an amount, which we call it as the maximum amount, which is not chargeable to tax. If it exceeds, then it will be chargeable to tax. And that person will be called as an assessee. And once he is an assessee, he is chargeable to tax at a rate or rates. And these rates and rates are generally prescribed in the Finance Act. But still, there are some rates which are prescribed in the Income Tax Act also. Okay. And we need to refer to the Finance Act of the relevant previous year. Okay. We don't know what is previous year, what is assessment year. These things we have not yet learned, but we'll be learning that thing. But we got some idea that tax rates are prescribed in the Finance Act as well as the Income Tax Act. Okay. And every person is chargeable to tax. Then, friends, we have understood that what is the meaning of this person. And we have seen that law has prescribed an inclusive definition. Right? Yes or no? And according to that inclusive definition, there are 7 categories of persons. Okay? Right. I think some of you will be able to recall what are the 7 categories of persons. First one is individual. Can you tell your other? Yeah. HUF, please. Your volume is very low. Yeah. Individual. Next is HUF.
Company.
Okay.
Association of individuals or body of individuals and association of persons,
Okay.
company, then artificial juridical persons and the local authorities.
Yes. So let me tell it in a sequence. So let us say individual, HUF, FAR, which includes LLP, then company, then BOI, that is association of person or body of individuals, then local authority, then artificial juridical person. Okay, so these are the 7 category of person we had seen in our previous session. Okay, previous session recorded classes you can also refer to, and you can find out this is the list of person. And we have also tried to understand what is the meaning of individual, what is the meaning of HUF, farm, company, etc. And one more thing is also important to us, that the definition of company, which is there in Income Tax Act, is different from the definition of company which is given under Companies Act 2013. So you have to clearly understand both the definition as per Companies Act 2013 and definition according to Income Tax Act 1960. Okay, so that is important for us. Okay, after that, what we have understood that once we know is a person, then we have seen that that person's total income is chargeable to tax. And we have already learned some basic things about this concept of total income. Now today we'll focus in that area. First, we'll see what is the meaning of total income. Right, friends? Now I'm going to share the screen with you. Just have a look. First, we'll start our understanding from the concept of total income. And you know, it's the total income which is chargeable to tax. Okay, to understand the meaning of total income, first of all, we need to understand what is the meaning of gross total income. From that gross total income, we'll be able to arrive at the total income. Right? And as you see in the screen, there are some heads of income. Tell me how many heads of incomes are there? Okay, there are 5 heads. 5. 5. Okay, and read the names carefully. Can you read it out? Number 1.
So salaries, income from house and property, profits and gain of business or profession, capital gains, income from other sources.
Okay, so these are, you see, the 5 heads of income. And under this head, there might be many sources. Okay, sources are different, heads are different. This thing you have to keep it in your mind. For example, one may have multiple sources of income from house property. He might be having 5 houses. He might be having 10 businesses. Okay, all are all these individual sources are different, and finally their sources are aggregated under a particular head, and all these incomes under different heads are aggregated. After and income tax law prescribes different methods of computation of income under these different heads. Okay, 5 heads I told you. Under these 5 heads, income computations are different. That is, method of computations are different. It's not that in a particular way you will be able to compute income under different heads. For example, if you talk about salary income, salaries, the exact name of the head is salaries. Okay, if you refer to Income Tax Act, where it is written as salaries, and if you refer to that head, you'll find that it talks about certain types of certain components of the salary, like basic salary is one part, some allowances are also there, some perquisites are there, some profits in lieu of salary. These are various components of the salary. Okay, and there are various methods of computation. For example, house rent allowance, different. There is a particular way of computing how much of this will be considered as an income. Right. Similarly, just like allowances, there are certain perquisites. Let us say free vehicle is given to someone. So how that will be valued and how that will be taken as an income, that computation methods are different. Okay. Similarly, there might be perquisites like allowances, profits in lieu of salary. All these things will be lying. Okay, and there will be some deductions also after arriving all these things under salary head itself. There will be some deductions. Okay, by following that procedure only, we will be able to compute income under the head salaries. That is basic salaries plus allowances plus value of all these perquisites plus value of profits in lieu of salary minus some head specific deductions. We will be getting income under the head salaries. Okay, what is the next head? What is the next head?
Income from house property.
Income from house property. Income from house property, law has suggested a different method of computation. What is that? We need to arrive at the annual value of house property. Okay, we'll find out the annual value. The concept of annual value we'll be learning at appropriate time. But right now, just remember that annual value will be computed with reference to rent. But it is not necessary that house should have been rented out. Meaning, even if you are not receiving any rent from the house, still your income from house property may be taxable. Okay, because it is the annual value which is taxable, not the actual rent received or received. Okay, but there is some relation between the actual rent and the annual value. We'll be learning at appropriate time. Okay, is it clear to you how salary income is computed, how income from house property is computed? Is it clear to you?
Yes, sir.
Basic level. Okay, in detail we'll be there. What is the third head?
Profits from business or profession.
Profit and gains of business or profession. Here you see, it is very difficult to define how this income or set out the procedure that how this particular income will be computed, because there are various types of businesses out there and they're unique in their operation. You cannot say that in this business you have to compute profit in this manner. In some other business or some other profession, you might have to compute income in a different manner. Is it not? Business is a very complex process. So law has not defined how to compute income. Okay, how to compute income directly. Rather, it has been prescribed or it has been another indirect way it has been explained. How it is that? Under income tax law, what you have to do, you first of all, you compute your profit as per your business by following the normal method, what you feel best for your business. Okay, you compute your own profit. Suppose you feel that I will be computing sales in this manner, I'll be deducting my expenses in this manner, finally I'll be computing your profit. You compute that. Now pick up that profit. What law will do after that? Law has suggested certain deductions which you might have allowed, certain expenses you might have allowed, that may be disallowed. So that will be added up. And certain incomes you might not have recognized, that should be recognized. So that means that will be added to the income. Right? So out of your profit, out of your normal business profit, Something will be added, something will be subtracted. The final figure will be your income under the head profit and gains of business or profession. Are you getting me?
Yes, sir.
Right? For example, you are doing a business. You tell me what is your profit. Suppose you are saying my profit is 5 lakh. I say, okay, 5 lakh, I will take it as 5 lakh. But if you are normal method, then let me see your statement of profit and loss, how you have computed. Oh, you have included a particular expenses, which is a personal expense. I will say, okay, this will be disallowed. So I will add it with your income. Okay, I have seen you have incurred some expenditure for your personal vehicle, you have put petrol. Okay, that will be added. So 5 lakh, this is, let us say, another 10,000 is added. So 5 lakh 10,000 is your income. Or let us say you have missed out some income. There is an interest income in your bank, you have not taken it there. I'll say, okay, that thing also I will be adding. So another maybe 5,000 or 10,000 rupees I'll be adding. So like this, I'll be adjusting your profits which you have already derived. This is how I'll be computing your income under the head business or profession. Okay, friends.
Yes, sir.
Right? What is the next step?
Capital gains.
Okay, under capital gain, what I will do, I will first find out, or an assessee is supposed to find out whether it is a capital asset or not. In appropriate time, we will be learning what is a capital asset. And if it is a capital asset, the next thing is that I have to see whether the transaction is a transfer or not. If a capital asset is transferred, then only there will be a capital gain. It can be a long-term capital gain, it can be a short-term capital gain also. Right? Accordingly, long-term capital gain will be taxed in a different manner, short-term capital gain will be taxed in a different manner. Okay?
Yes, sir.
Yes, sir.
Right. Now, last head, what is the last head?
Income from other sources.
Income from other sources. Here, what will happen? I'll find out what is your income from various sources, which are not from various, you can say, various sources which are not included, which is not coming under salary, let us say house property, profit and gains of business or profession or capital. That I will find it out. Then I will find out how much expenditure you are incurring to earn that income. That will be subtracted, and the net amount will be your income from other sources. This is how we'll be computing. Right?
Yes.
Right. Now, friends, once again, let me share the screen with you to explain you the concept of gross total income. Now you see gross total income, you see, this is why it is listed: salaries, income from house property, profit and gains of business or profession, capital gain, income from other sources. All these things will be aggregated. Okay, if you aggregate, still you are not getting gross total income. If you are aggregating, you are getting a figure only. We can at best call that figure as total, but that is not a gross total income. What is gross total income? This aggregate figure, aggregate means aggregate of the income computed under all these 5 heads. Right? These aggregate figures will be subject to 2 adjustments. What are these 2 adjustments? Now you can read it. One is clubbing provision. Second is setup of carry forwarded losses. Okay. Right. Did you remember? One is clubbing provision. Second is setup of carry forwarded losses. Okay. Now you might be thinking, what is this? Clubbing provision means in some specific situation, we'll be learning that chapter separately. In some specific situation, income of some other persons will be clubbed with the assessee's income. Okay, it may be income of a minor child. It may be income from income of a spouse. So that income in some specific situation, not all situations. For example, let us say a minor child is earning some income by using his own skill and talent. That is his income. He will be filing separate income tax return for that. Is not his father's or mother's income, because the minor child has used his own skill, one's talent. For example, let us say a minor child has participated in a TV show and earned some income. That is his income. That's not parents' income. That is not going to be clubbed. But let us say parents have kept some fixed deposit in the name of minor child and interest is accrued. That is to be clubbed with the parents' income. That will be learning separately in a separate check. Either of the parent whose income is higher, that is either father's income or mother's income. Whose income is higher, this minor child's income will be clubbed with that. So this is an application of clubbing provision. Similarly, in certain situations, spouse income will also be clubbed. Now, after computing income under these 5 heads, now we'll see whether clubbing provision is supposed to be applied. If it is to be applied, we have to apply clubbing provisions. Okay, that is one more adjustment. Got it?
Yes, sir. Yes, sir.
Next,
Yes.
one more adjustment is still required. What is that? Setup of carry forwarded losses. That means if loss was there and that has been carried forward, now you have to set it off. For example, let us say last year you had a business loss of 2 lakh rupees and you have filed your return in time, and in the return you have carried it forward, and carry forward is allowed. Got it? And current year you are having a income of business income of, let us say, 30 lakh. 30 lakh is your income, but you had a carry forward loss of 2 lakh rupees. That carry forward losses is going to be set up. Effectively, your income will become how much? 28 lakh. Got it?
Yes, sir.
28 lakh. So this is called as the concept of setup and carry forward of losses.
Sir,
Yes.
sir, outside is sir, will you please explain the last part once again, sir? About the carry forward amount.
Sorry, please ask me once again.
Sir, can you explain the last part of the carry forward amount, that how
Okay,
it
you want
became?
to know what is the concept of carry forward of losses. Okay. Carry forward of losses concept is that if someone is having some income in a particular assessment year, he can carry it forward up to certain limit, depending upon the types of income, right? So normally up to 8 years one can carry forward. So we'll be learning that chapter separately. Okay, that means suppose this year you have earned some losses in your income. You can carry it forward to the next year and get it set up against next year's income, provided you are filing your return in time. Okay, within due date, if you have filed your return, you have to file your return showing that you have incurred a loss. And also you have mentioned that you are carrying it forward. If you're carrying it forward, let us say last year you have carried forward a loss amounting to 3 lakh rupees. From your current year's income, from the eligible income, this will be deducted. This will be set up. But there are conditions for this setup. In appropriate time, we will be learning that. Okay, not that against any income we will be able to set it up, but against similar kind of income, we'll be able to set it up. Okay.
Yes,
Got
sir.
it? Is it clear to you? Okay. So after these two adjustments, what I will be getting, resulting figure will be called as GTI. GTI means
Gross total income.
gross total. I got it. Okay. But that's not enough. So what I told you right now, now you have to tell me. First I told you salaries income. Okay. There might be It consists of basic salary, allowances, perquisites, profit in lieu of salary. Then it will be subject to some specific deductions. That is salary. Number one. Number two, income from house property. Okay, income from house property. What is taxable is annual value. There will be some deductions also, chapter specific deductions. Right? Number three is PGBP. PGBP, what will do? You find out your normal business profit. It will be subject to some adjustments and also certain deductions. Certain deductions are also allowed. Your business profit will be arrived at, then that business profit will be subject to some adjustment, some additions, some deductions, some subtraction has to be made. Because when arriving at the business profit, you might not have included some income. We might have allowed some expenditure which is otherwise not allowed under income tax law. So that adjustment has to be made. Fourth is capital gain. Okay, here we have to find out capital asset transfer. We have to find out whether it is a long-term capital gain or short-term capital gain. And it will be also subject to some deductions. We'll find out. Lastly, income from other sources. We'll find out your income. Certain deductions are allowed. We'll be getting that. Then what we'll do, we'll be aggregating all these incomes. We'll find out a figure. Okay. Then you tell me this figure, there is no name what I can call it. In income tax return, it is called as a total. If you refer to income tax returns, you can only call it as a total. It is not your total income, it is total. Now, what next? Two adjustments. Then I will be getting GPI. What are the two adjustments? Clubbing. If clubbing is applicable, then R. If it is applicable, it's not applicable, doesn't matter. Then setup of carry forward losses. If it is applicable, then deduct earlier years. Finally, you are getting a figure. Okay, that figure will be calling as what?
Gross total income.
Gross total income. Understood? But friends, we have seen in the scheme of taxation, what is taxable? It is total income, not gross total. Now, from gross total income, these are the individual chapter specific deductions are over. There are some other deductions. That is called as, you already know this, chapter 6A. Previous class we are learning. Chapter 6A deductions will make, then you will be making, then you will get total income. Okay, total income after this chapter 6A deductions. Got it?
Yes, sir.
Yes, sir.
Oh,
Yes, sir.
good. Now, friends, let me show you with the help of slide. Now, once I know the gross total income, how to arrive at the total? Right. Total income, if you refer to section 2 plus 45, you can refer to Income Tax Act. Now you are familiar, you can go to the website, you can refer to this. Section 245 defines what is total income. It says means, that means it is an exhaustive definition, means the total amount of income referred 2 in section 5 computed in a manner laid down in this act. That means the way it has been prescribed in the act, you have to compute. Okay, how it is to be computed in the manner laid in the act? Just now we are discussing how under different heads you have to compute. What section 5 says? Section 5 talks about how to compute income depending upon a person's residential status. Therefore, you know from the beginning, this total income depends on the residential status. Okay, law has made it clear, total income you have to compute with reference to section 5. So that will be learning what is the residential status, how total income will be computed subsequently. But right now, let us see that once you know the gross total income, then you can allow deductions which are there under chapter 6A. Okay, and these are the deductions starting from section 80C to 80U. The list of sections are there. Okay, after deducting this, you will be getting total income. Okay, friends. Now, this total income will be rounded up upward to the nearest rupees 10. Okay, what is upward rounding up? Let us say 5,23,577. The 577 will become 580. Okay, to the nearest rupees 10. Okay, let us say it is 572. It will become how much?
70.
70.
70.
If it is 575,
The 580,
80, not 70. That is upward rounding up. Upward rounding once 5 will become 10. It will go upward. Okay, up to 4, it will become the previous tens. Got it? So this is how we'll be able to compute total income. And that total income is subject to tax, subject to income tax. Got it?
Yes, sir.
yes, sir.
Now, what I explained you, these are the 5 heads of income. You can see it here. And under this income, there might be various sources. So sources are different. Heads are different. Sources may be many, but heads can be only 5. Now, I told you this deductions. Chapter 6 deductions. That also in appropriate time you can learn it, or you can refer to chapter 6. I had chapter 6, I had shown you how to refer. You can go to Income Tax Department website, go to the section Acts, Rules, and there you can find out Income Tax Act. Chapter wise, you can see chapter 6A, or section wise, you can see ETC onwards. You can find it out. You can know what are the deductions which are allowed. But if you analyze the deduction, you'll find out there are certain deductions which are based on some payments. That means if you make some payments, you'll get some deduction. Many of you might be aware of that. That means if you pay life insurance premium, you will get some deduction. If you contribute to Provident Fund, you will get some deduction. If you buy medical insurance premium, you'll get some deduction. If you pay interest on higher education loan, you're getting some deduction. Okay, if you're paying interest on a loan taken for residential house, there is some deduction. Okay, if you're making some payment of interest for purchase of electric vehicle, deductions are there. Deductions are also there for rent paid, for donations made to certain funds or charitable institutions. Even deductions are made for contribution to political parties. So these are some examples only. Are you seeing the list? Deductions in respect of certain payments. But friends, this is not the exhaustive list. Exhaustive list is, you can refer to the chapter, but these are only examples. Okay, so that you can have some broad idea that these are the some areas. If you contribute, you can get some deduction from your gross total income. Consequently, your total income will be less and you'll be able to save some tax. And there are some deductions which are given on the basis of some incomes. That means if your income includes some specific type of income, then only the reductions are allowed. Like employment of new employees in some certain entities. If some new employees are employed, they can get some deduction. Or royalty income from authors of the books of certain textbooks. Or royalty on patents. Like this, some deductions are allowed. Next is, if your income includes some other type of income, like interest deposits and saving bank account. So you'll be learning a section 80 TTA, where a normal person can claim a deduction up to 10,000 rupees if interest is from saving bank account. And senior citizen can claim up to 50,000. So since they are having other income, not normal business income, salary income, but they're having this interest income, they can claim this deduction. Okay, and in addition to that, there is some miscellaneous deductions also, like deductions in case of a person with some disability. Those type of persons can also claim some deductions. So this is only a broad classification that what are the possibilities of deductions. But detail, if you want to list, you have to read the entire chapter 6A. Okay, friends. I think you got some broad,
Yes, sir.
I think some broad idea you are having now.
Yes, sir.
Yes, sir.
Okay, just have a look. These are the possibility of reductions. Now, friends, look at this complete chart. It will give you a detailed idea how total income is computed. Okay, just have a look. Are you getting it? Are you able to understand this chart?
Yes, sir.
Yes, sir.
Yeah.
Yes,
Can
sir.
any of you explain me what is the meaning of this chart? Please explain me this picture.
So can I?
Yeah, please do it.
So as we know, there are 5 heads of income.
Right.
Starting salary, income, house property, profit gain, capital gains, and income from other sources. All
Right.
this has to be computed, and we have to do certain deductions, and like all this have to be included, and then we get the total. Then we deduct the, if applicable, we deduct the set of carry forwarded losses. Then if applicable, then we add the clubbing provisions, where the income from some other persons are included with the assessee. Then we get the gross total income. And then to compute certain gross total income, there has to be certain deductions as per as mentioned in the chapter 6A of the Income Tax Act. And
Very
then we total income.
Okay, so one thing you forgot, that is, before that you need to consider the residential status. Is it not? This part, residential status. Okay, yes or no? What is that residential status? Of course, we have not discussed, but if you refer to the meaning of income, what it says?
Sir, more than 10 lakhs people who earn more than 10 lakhs, they can have the residential status, like on the basis of income, sir.
No, your question is what? How residential status is decided?
Yes, sir.
Okay, how residential status is decided, I'll be explaining you after some time. But it is not on the basis of income. Okay, it depends for different kind of persons. You know how many kinds of persons are there?
7 kinds.
7 category of persons. So the way residential status will be decided from individuals, different from a company, different from a firm. We'll be learning all these things. But mostly at this point of time, you see, it depends upon how many days where one person is residing or where from that entity is being controlled. On that basis, it will be decided, not on the basis of income. Okay, Why 10 lakh? One person might be having 1 rupee income, but still he may be a non-resident or resident. It doesn't matter. It can be on some other basis that will be decided. Okay.
Yes, sir.
Okay. Now I will do one thing. So again, I will draw your attention to this particular section, section 2, clause 55, where total income is defined. And I have been telling that total income is taxable, not gross total income, not the total, only total income is taxable. Right. And this definition is what? Inclusive definition or exhaustive definition?
So, actually both.
Exhaustive, you can say.
Exhaustive.
You can say means. Okay, means. And you have to compute in accordance with the section 5. So section 245 is important for us. Right. Section 5 is important for us. And one more thing which is important for us is the section 14. Okay. Section 14 is also important for us. So have you remember section 14, which talks about heads of income, section 245 and section 5. Okay. Would you like to see these sections? Let me take you to the Income Tax Department's website. Okay. Should we go there?
Yes, sir.
Have you remember the
Yes,
sections? What I told you? Which are the sections? Section
Yes.
245, section 5 and
Section 14 for gross
section
total.
14. Section 14. Okay, friends. Let me show you. Yeah, are you able to see the Chrome browser?
Yes, sir.
I'm taking to this site, Income Tax India .gov.in. So you have to go to incometaxindia.gov.in, not incometax.gov.in. Incometax.gov.in is a site for filing of income tax return. But for the department site, you have to go to the incometaxindia.gov.in. Okay. Incometaxindia.gov.in. Okay, this is the site of Income Tax Department of Government of India. Are you seeing it?
Yes, sir.
Now,
Yes,
I
sir.
have taken you to this particular link, apps. Then you go to Income Tax Act. First, I told you what is the section? Section 2?
245.
245. Let us go to section 2, clause number 45. Okay, section 2, you see clause number 45, just have a look. Are you able to read it? Some of you may read it.
Total income means the total amount of income referred to in section 5 computed in the manner laid down in this act.
So now tell me exhaustive definition or intrusive definition?
Exhaustive.
Exhaustive. But you have to refer to section 5. That means ignoring section 5, you cannot find out the total income. Okay. So you can go there, go back and find out section 5, or you can directly click here. Here is a hyperlink you see. You can click here, you can go to section 5. Should I go there?
Yes, sir.
Yes, sir.
Section 5, if you click here, you see section 5 is open. So here you think right now it may be a little difficult for you to understand this thing. It talks about depending upon the resident, which kind of income will be added. Income received or deemed to be received, income accrues or arises, income accrues or arises him outside India, like this, something, some things are described here. I will be explaining all these things later on when we will be learning residential status. Okay, just keep in the mind that a person who is a resident and ordinary resident, we need to know the person's residential status, then only we will be able to compute the total income. Okay. Now we'll go back and we'll be learning the other section. What is the one more section I told you? Section
14.
Section
14.
14. So I can go to Income Tax Act and let me search here section 14 directly. Now you can find out the heads of income there. You see 14 talks about heads of income, right? Now you see, click here, you can find out section. This talks about, these are the heads of income. Can you read them?
Yes, sir. First it talks about salaries, then
Okay,
income from house property, profits and of business or professions,
yes.
capital income from other sources.
Okay, capital gains income from other sources. In between, you can find some part is missing, is it not?
Yes, sir.
Yes, sir.
B, you see something is missing. So you might be wondering what is that? Want to know what is that?
The residential status.
No. This is not residential status.
So there might be some things that which has been repealed as of now.
Yeah, which has been repealed. You are 100% right. Now, when I showed you this slide, now you are seeing the slide.
Yes, sir.
You see, salary starts from section 15 to and ends with section 17. And income from house property is starting from section 22. So what are these sections? 18, 19, 20, 21. These are missing. Okay. So at that point of time, earlier there was one more head. Now there are 5 heads. Long back, there is one more head of income that is called as estate duty. Estate duty means when person dies and his properties gets transmitted to some other person. Okay, his legal heir is supposed to pay that tax. That is called as estate duty. That was containing in those sections. Right. So a lot of people criticize that particular tax. Even at that point of time, it is said that Mr. Ram Manohar Lohia spoke to Mr. Pandit Jawaharlal Nehru, who was in. It is said that he was also handling the finance ministry. That you see, in our country, if you earn income, we are paying income tax. If you save income, wealth will be accumulated and we are paying wealth tax. And if you spend income, we are paying expenditure tax. Okay, if I give the income to somebody, we have to pay gift tax. And finally, person gets fed up by paying so many taxes and commits suicide. He has to pay estate duty. So whatever he is doing, he has to pay some kind of tax. Okay, so this caused some genuine hardship to a lot of people. So after that, those particular sections, those sections are repealed. Now they are not there. So estate duty is removed in our country. Wealth tax is also not there. We had seen it, but now in our life also we had seen wealth tax. Now it's not there. Gift tax was also there. That also we have seen. That is not there. So many taxes are removed. Fringe benefit tax, one more tax was also there. That was removed. Now very limited taxes are there. Indirect tax, income tax, and indirect tax, goods and services tax, and partially some excise duty is also there. Customs duties are also there, like that. It's a very limited number of taxes are there now. Okay, friends. So
Yes,
friends,
sir.
we'll do one thing. We'll take a break right now. Okay, we'll resume immediately. Yes, friends, welcome back. So in the just now I was showing you this particular picture. And this picture, with the help of this picture, we are understanding how total income is to be computed. And we have understood one thing is that total income is determined on the basis of residential status, and there are 5 heads of income. There might be deductions under each of these heads, and finally there will be some general deductions which are called the chapter 6 deductions, and clubbing provisions may be applied. Set up and carry forward of losses, that provision also may be applied. Finally, we will be getting the total income. Once that total income is there, that will be chargeable to tax. Is it not? If you recall the first sentence that we have learned, that every person's total income of the previous year exceeds the maximum amount which is not chargeable to income tax. Now, friends, it is time to learn what is that maximum amount which is not chargeable to income tax. That is called as, that you can get it when you refer to income tax rate or rates. Okay, now how to refer to that income tax rate and rates? I'll do one thing. Let me take you to income tax website again. So you have to visit this website frequently. Right? Are you comfortable visiting this website?
Yes, sir.
Yes or no?
Yes, sir.
Yes, sir.
I'm going back again. I'm taking you to the home page. Let me go to the home page. Feel very comfortable with this website. Whenever time permits you, you can visit this website and learn so many things. So I had told you earlier that you can visit this area: acts, rules, circulars, notifications, etc. You can see everything. But right now, I'm taking you to some other area. So, okay, one more. In the meantime, I will tell you may also visit to this particular area. Can you see what is there?
Tax tutorials.
Tax tutorials are very much helpful for students. If you click here, let me show you. You can find out tutorials on many areas. Let us say you want to know what is permanent account number. You can click here. You can understand everything. Okay, so many tutorials are there. Okay, you see what is, let us say you want to know what is minimum alternate tax, MAT. What is tax-free income? How income from house property will be computed? What is the tax treatment of cash credit? What is the long-term capital gain? Are you seeing these tutorials? So many pages are there. So department has already prepared some notes and readily made available for you. So please make extensive use of that thing. So as we know, this tax tutorials, I expect that you will be visiting this area. Okay. Fine. Now, yes or no? Okay. Now I'm taking you to this one more link you see. Can you read it? What is written here?
Tax charts and tables.
Tax charts and tables.
Tax.
Let me take you to here, to this place. Tax charts and tables. Okay. Here, if you find, after clicking here, you can find one more place, tax rates. Okay, we are interested in rates. We want to know what is the total amount, what is the maximum amount which is not chargeable to tax, and also we are interested to know what are the rate and rates. Fine. So rate and rates, you need not ask anyone. You need not refer to any other source. You need not see with the ready reckoner or let us say your diary to find out what is the income tax rate. Tax rates are available. It is in their mobile phone. Go to Income Tax Department website. Here you see, you can go to charts and tables. You can find out tax rates. If you click here, you can find out, see, for assessment year 22-23, that is the rate. So up to 2,50,000, what is the rate?
Nil.
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 So now I'm asking you a question. After that, you see, above 2,50,000, up to 5 lakh, what is the rate?
5%.
5%. Now I'm asking you, what is the amount of income which is not chargeable to tax, or what is the maximum amount of income which is not chargeable to income tax? What you would say?
2,50,000.
Fantastic. 2,50,000. And this is for
Under 2.5 lakhs, sir.
yeah, up to 2,50,000. That means including 2,50,000. Okay, 2,50,001, there will be tax. Okay, up to 2,50,000, there is no income tax. Okay, are you getting?
Yes, sir.
Yeah. So, but this is for whom? You read it on the top. In case of an
Individual
individual, then
or HUF or association of person or body of individual or any other artificial juridical person.
for them only this is the tax rate. And the maximum amount which is not chargeable to tax is 2,50,000. And you see, can you read it here? Who is
60 years or more at any time during the previous year.
now? You see now what is the maximum amount which is not chargeable to tax?
3 lakhs.
3 lakhs.
3 lakh.
3
So
lakhs.
these people who are attending 60 years at any time during the previous year, any time means even on the 31st March, they are of 60 years of age. That's the last day of the previous year. Still they are senior citizens. Okay, anytime. It's not that throughout the year they should have been senior citizen, or at the beginning of the year they should be senior citizen, not necessary. At any point of time. Okay. Understood? So we'll be calling
Yes, sir.
as senior citizen. Now you see one more category I'm showing you. You see what is the age here again? Who is
80 years or more at any time during the previous year.
at any time. And we'll be calling this kind of people as what?
Super senior citizen.
Super senior citizen. And if a person is super senior citizen, tell me what is the maximum amount which is not chargeable to tax. You see, this is the slide.
5 lakhs.
5 lakh. Okay, so this is for individuals. For HUF, this is the category up to 2,50,000 rupees. It is exempt. It is not chargeable to tax. After that, rate is there. We'll be seeing all these rates. Some surcharge concept is there. We'll be learning at appropriate time. And for assessment year 21-22 and also for 22-23, there is a optional scheme. That tax may be, one may go for paying tax at a lower rate, that up to 2,50,000 nil, then 2,50,000, about 2,50,000 up to 5 lakh, 5%, then 10%, 15%, 20%. This is one more rate is also there. So whatever may be for individuals, we have seen that up to 2,50,000 there is no tax. Right? Okay.
Yes, sir.
Yes,
Right.
sir.
For partnership firm, different rates are there. We will be seeing it. Okay, 30% you are seeing, this is the rate. For local authority, you are seeing again 30% rate. For domestic company, rate may be 25% or 30%. In some situations, it may be lower than that also. Okay, for domestic companies. Okay, like it can be 22% in some specific situations. Some cases 15% also. Like this thing, minimum alternate tax, etc. For foreign company, you see there are two possibilities, either 50% or 40%. We'll be learning all these things, with which case it is 40% or 50%. But you see, domestic company, partnership firm, there is no basic exemption limit. That means whatever they earn, they have to pay tax either 50%, 40%, 30%, whatever may be the applicable tax. Okay. For cooperative society, you see there is a different rate, and for some, you see rates are up to 10,000 rupees, 10% and 20%, 30% for cooperative society. But some specific income, it will be 22%. Like this, rates are there in under income tax. Okay. Now, friends, we are going to learn what is the maximum amount which is not chargeable to tax. Now you see, this is the maximum amount which is not chargeable to tax. Now you must have understood. You have already seen it. For individual, HUF, AOP, BOI, AJP. What is the maximum amount which is not chargeable to tax? Now tell me once again.
2.5 lakhs.
And for senior citizen,
3 lakhs. For 3
3
lakhs.
lakh, 3 lakh. Who are senior citizens? More than 80 years of age, but less than 80 years. More than or equal to 80 years, but less than 80 years.
So
Super
there's senior citizens. No?
Super senior citizen is more than or equal to 80 years of age at any time during the previous year. Okay. Understood. And what is the maximum amount which is not chargeable to tax?
5 lakhs.
5 lakhs. Right. So, and for all other assets, all other assessments, excluding individual, HUF, AOP, BOI, AJP. What are the other assets? Maybe farm, local authority, company. Okay. Yes or no? For them, there is no basic exemption limit. For all other assets, it is what? How much?
Also, depending on the individual, then that it is 2,50,000 for senior citizens who are like 60 years, but but less than 80 years, that is 3 lakhs. For super senior citizens, for more than 80 years or equal to 80 years, then it is 5 lakhs.
No, I'm asking about other assets. Like for a company, for a farm, for a local authority. You see, there is no basic exemption limit. That means if the rate applicable is 30%, if they earn 100 rupees also, they have to pay 30. There is no basic exemption limit. Okay. Is it clear to you?
Yes, sir.
Yes, sir. Yes. Sir.
Okay, fine. Now, friends, we'll be coming to the rate and rates of taxes later on. And also we'll be learning about the chargeability of the tax maybe later on. But right now, it is high time to understand the meaning of assessees. Now, what will happen? The tax rate or basic exemption limit will vary from assessee to assessee. Okay, so let us understand the meaning of assessee. When we are initially, I had told you that meaning of assessee is defined under section 2, clause 7. You can check it later on. But here, the same definition is straightway copied and pasted. You can see here what is the meaning of assessee. And first, I will expect you to read this particular thing and tell me what kind of definition it is. It is an exhaustive definition or inclusive definition or some other type of definition.
Sir, both.
Both. Can you read this entire definition?
Yes, sir. So,
Please.
assessee means a person by whom any tax or any other sum of money, interest or penalty is payable and includes every person in respect of whom any proceeding under the Act has been taken for FBT loss refund. A person who is deemed to be an assessee, assessable in respect of other person's income, legal representative, agent, trustee, guardian in case of minor. Every person who is deemed to be an assessee in default under the provisions of the Act fails to comply with the duties imposed under the Act.
Okay. Friends, whatever is there in the bracket, they are not the part of the definition. I have included only for explaining, right? So now you have seen it is a definition which is inclusive as well as, which is exhaustive as well as exclusive. It says means a person by whom any tax or any other sum of money is payable. That means if the tax is payable, when tax is payable, when the basic exemption limit exceeds, is it not? If tax is payable or any other sum of money is payable, he is 100% assessee. because assessee means a person by whom any tax or any other sum of money is paid, and includes. This part is the inclusive and also includes this thing. So these three things are specifically included. There might be any other situations also because this part is inclusive. Okay, if tax is payable, he is an assessee. But even if tax is not paid, let us say someone has paid the tax, but he has not paid the interest due, or he has not the penalty, he has not paid penalty. Can we call that person as assessee? Yes or no? Yes or no?
Yes, sir.
Yes, because it says tax or any other sum of money is payable. So not necessarily tax alone. Okay, if interest is payable, penalty is payable, or any sum of money is payable, that person is an assessee. And what is included here? Every person in respect of whom any proceeding under the act has been taken. That means, let us say, even if nothing is paid, but a proceeding is going on, that means one income tax case is going on. Maybe for assessment of income tax, maybe income tax is not due, but earlier there was a tax called as a fringe benefit tax. That assessment is still continuing, FBT. Or it is not about tax, but it is about assessment of losses. You know already that in case of loss, you are eligible for carry forward. Yes or no? But for that thing, I had told you also, you need to file your return. Your return has to be filed in time. Let us say that loss assessment is going on. Tax is not due, but loss assessment is going on. Then a proceeding is going on. Or a proceeding is going on against regarding some refund. You have claimed a refund of 2 lakh rupees, but department is saying not 2 lakh, I'll pay you 1.5 lakh, and proceeding is going on. Then you are still an assessee because the proceeding is going on against you under the Act. And here Act means Income Tax Act only. Got it?
Yes, sir.
Yes, sir.
Then one more category of assessee. A person who is deemed to be an assessee, that is assessable in respect of other person's income. In certain situations, person is assessable in respect of other person's income. For example, in case of legal representative of a person, the legal representative is assessable. Some situations, agents, trustees, or guardians in case of minor, they are also assessors. Let us say minor is the assessee, but the guardian is the deemed assessee. So the deemed assessees are also assessors. Third situation, a person who is deemed to be an assessee in default under the provisions of the Act. That means even if nothing is payable, no assessment is going on, no proceeding is going on, he is not a deemed assessee, but still he can be an assessee if he is an assessee in default. He has paid all the tax, paid the penalty, he has paid the, let us say, interest, everything is paid, no proceeding is going on, but he has defaulted. So under Income Tax Act, there are many other compliance requirements are also there. One is supposed to comply with the. For example, let us say you have deducted tax at source. You need to file a TDS return. Or you have paid your tax. That's not enough. You are also supposed to file your income tax return. And in certain situations, will be paying tax, but you are also supposed to pay advance tax. Okay, in different situations, there are many forms or many returns which needs to be uploaded, needs to be filed. If that is not done, then you are an assessee in default. Okay, tax law also requires in certain payments you have to deduct tax at source. Some situations you are also supposed to collect tax at source. They are called the Tds and Tcs provisions. You are supposed to do that. And if you have defaulted, then you are also an assessee in default. Got it?
Yes, sir.
Yes, sir.
Okay. Now have a look at the provisions once again. What is the meaning of assessing? That's important for us. Section 2, clause 7. When tax is due or any other sum is due, when proceedings are going on, when a person is a deemed assessee or a person is an assessee in default. In all these situations, a person can be called as an assessee. Okay. Okay, friends.
Yes, sir.
Right.
Yes, sir.
Right. Now, having understood that concept of assessing and total income, persons, now this is time to understand these two more important terms. One is assessment year and the other one is previous year. Okay, both the terms are relevant for us because income which is earned during the previous year is assessed to tax during assessment year. Okay, and if you have remembered the earlier sentence that we have written that every person has a total income of the previous year. That means total income of the previous year is relevant. And it will be taxed at the rate of rates which is prescribed in the Finance Act for the relevant assessment. Okay, we have to select the Finance Act which is relevant for my assessment year. Therefore, these two terms are relevant. If you see section 2, clause 9, it defines what is assessment year. It says means a period of 12 months. That means assessment year is always
12 months.
Always 12 months. Commencing on the first day of April every year. Okay, right now you see, if you say assessment year 21-22, that means it has commenced on 1st April 2021 and it is going to end on 31st March 2022. After that, assessment year 22-23 will be commenced. Okay, 22-23 will commence from which date and it will end on which date? Assessment year 22-23. Tell me.
So 1st April 2022.
It will commence, then when it is going to end?
So 31st March
2023.
31st March 2023. It is going to end. That is called assessment year 22-23. Okay, and we are learning the provisions, keeping in mind the provisions of assessment year 22-23. 22-23 is not yet started, but still we are going a little ahead. We'll be learning this thing. Okay, and the rates of assessment year 2023 is already available. Therefore, we are learning the provisions, keeping in mind assessment year 22-23. Here you have to remember that assessment year means always a period of 12 months. Okay, now what is previous year? Previous year, if you understand the meaning, you have to refer to section 234. But if you see section 234, you'll find it is written the previous year is the previous year as defined in section 3. That means without reading section 3, you cannot understand you cannot get the complete meaning of previous year. Okay, so if you refer to section 3, then you can get the meaning of previous year. So previous year, if you want to understand this, you have to read section 2, clause 34 with section 3. So section 2, clause 34 read with section 3. If you refer there, you can find, can you read it now? This particular point?
Yes, sir. Means the financial year immediately preceding the assessment year.
Yeah. So once you know the assessment year, then what is the previous year? It is a financial year. Nowhere it is mentioned that it is 12 months. It is mentioned here. The definition says means the financial year immediately preceding the assessment year. Assessment year is always 12 months. but previous year is the financial year which precedes the assessment year. So previous year can be less than 12 months, but it can never be more than 12 months. You might be thinking in which situation previous year can be less than 12 months. Imagine a person or a company is incorporated in the month of January. So his previous year may be 3 months, January, February, March. But assessment year is the 12 months. Let's say today one company is incorporated. His previous year is 2.5 months. Today is 15th Jan 2022. Right. So the previous year is 2.5 months. But assessment year will be starting from 1st April 2022. That will be 12 years. That is 12 months. So previous year can be less than 12 months. It can never be more than 12 months. Assessment year is exactly 12. Another example of this, you can say previous year, you can see, let us say a child is born, maybe today he is born, or a child is born on the 31st March. Incidentally, he is having some income. Then previous year maybe 1 day. Okay. But assessment year is always how many days? How?
12,
12 months.
12
Assessment year
months.
is always 12 months. Previous year maybe less than that, but assessment year is always fixed. Well, friends, now you can look at this slide. So in case of newly set up businesses, or when the new source of business and income is generated, previous year can be less than 12 months, but it is never more than 12 months, and assessment year is always 12 months. And why we are learning this previous year assessment year concept right now? Because we know that income which is earned in the previous year are supposed to be assessed to tax in the subsequent year, which is the assessment year. Okay, many times people say income is earned in the previous year and tax is paid in the assessment year. No, it's not. Tax is paid in the assessment year. Tax may be paid in the form of advance tax. Tax may be collected in the form of TDS also. Okay, tax may not be paid also. But income is to be assessed in the assessment. Okay, so tax payable in the income earned during the previous year, such income is assessed in the immediately succeeding financial year called as the assessment year. So when there is an income earned in the previous year, that has to be assessed tax in the assessment year. That is the normal process. Okay, normally income earned in the previous year and that will be assessed to tax in the assessment year. When that is the normal procedure, there are exceptions to it. And we'll be remembering the 5 exceptions. 5 exceptions means the normal provision is not going to apply. What will happen in those 5 situations? Income which is earned in the previous year will also be assessed to tax in the previous year itself. Okay. Which is not normal. Is it normal? For example, let us say you are earning salary now. Now means you are earning in the financial year 21-22. Right. And that will be assessed to tax in the year 22-23. So 22-23 is your assessment year. 21-22 is your previous. Okay. Is it clear? That's a normal thing. But in certain situation, your income may be assessed in the previous year itself. What are these situations? Let us learn quickly. There are in fact 5 situations where the income will be assessed in the same year. Now you see. Are you seeing the 5 points appearing here?
Yes, sir.
Yes, sir. Yes.
Number 1, you see, non-residents shipping business. Section 172 of the Income Tax Act talks about. So let us say a shipping company has a non-resident shipping company, right? and it is doing some shipping business. And let us say the non-resident ship has arrived in India and it has done some shipping business in India. Then if you allow, or if the country allows the ship to leave and assess that income the subsequent financial year, then ship may leave and one may not be able to collect tax. So in this situation, what the provision says, that income will be deemed as 7.5% of the money collected by the ship, and that will be assessed to tax when before the ship leaves India. Okay, that means in the same year, this can be computed. And income can be assessed to tax in the same. Are you getting me?
Yes, sir. Yes, sir.
Okay, so in respect of non-resident shipping business, income will be deemed to be 7.5%. The 7.5% is not the tax, it is the income. This will be computed on the turnover generated by that ship. Okay, on that tax will be collected before the ship leaves Indian port, and assessment will be completed. That is one instance. Second instance is that if the person leaving India permanently or for a long period, what is long period, it has not defined. So it depends on the assessing officer. He has to decide whether the period is long enough or not. Section 174 deals with that. In that case also, if the person is leaving India permanently or living for a long period of time, then also assessment shall be completed in the previous year itself. Okay, in that case, the person who leaves India is supposed to give a 7 days notice to the department. Department will complete the assessment in the previous year itself. Right? Understood?
Yes, sir.
Third instance is that an association of person, body of individual, or artificial juridical person, which is formed for a particular event or purpose, which is likely to be dissolved. Let us say for a particular purpose on AOP is formed, but joint venture has been formed for a particular purpose, for construct of a flyover or for conduct of a sports event, a particular association has been formed. And once that event is over, that association is going to be dissolved. After that, association will not exist. In that case, assessment will also be completed in the previous year itself. Okay, this is dealt in section 174A. Okay, understood?
Yes, sir.
Situation 4. A person trying to alienate his asset with a view to avoid tax. Let us say a person is disposing of or generously donating his assets. Okay, and income tax department comes to know that he is disposing of all his assets or is donating, distributing all his assets. So next year, nothing will be there to pay tax. Then in that situation also, and income tax department also have evidence that he is doing so to avoid tax. Then also assessment can be completed in the previous year itself, not in the assessment. Section 175 deals with that. And lastly, discontinued business. In case a business is discontinued, then assessing officer at his discretion, this is the discretionary power. Other 4 points you have learned it, they are mandatory things. That means assessing officer has to complete assessment in the previous year itself. But in case of discontinued business, it's a discretion of the assessing power, assessing officer, that he can complete the assessment in the previous year itself. Notice of discontinuance has to be given to the assessing officer within 15 days. And in that year, that is in the previous year itself, he can complete the assessment. Section 176 deals with that. So this, you have seen the 5 instances where the normal provision that Normal provision is that income of the previous year is to be assessed in the assessment year. Okay, normal provisions are not applied, meaning there are exceptions to that. So these are the exceptions you can see. One is non-resident shipping business, persons living India permanently or for a long period of time, AOP, BOI, HIP, which are formed for a particular event and purpose, which is likely to be closed, and person likely to transfer the property to avoid tax, and in case of discontinued business. In all these five situations, this income is to be assessed in the previous year itself. But the last one is discretionary power, and the previous 4 points are mandatorily has to be applied. Okay. Understood?
So I have a doubt.
Yes, please.
So, like in the point number 3, the artificial juridical person formed for a particular event or purpose. So
Yes.
in Odisha, we have Durga Puja committees, and West Bengal also Durga Puja committees and all.
Yes, yes.
So they are conducted for their organized. Their aim is to conduct a particular event, and they have
Yes.
a particular purpose. So
Yes.
whatever income they earn, that has to be assessed with the previous year. So can that be an example of?
So in that case, what happens? Normally, what happens? That kind of AOP continues to conduct that kind of puja year after year. Okay, it is not that for a particular event, once the event is over, the association is closed. It's not like this. But in case if you are organizing an Olympic kind of thing or some kind of sports, once the tournament is over, the association will be over. Then the income will be assessed in the same year. That means in the previous year itself. But regularly you are organizing events. That means association is not going to be closed. AOP is not going to be closed. Okay, event is closed, but that is not just one event. Another event may come. Are you getting it?
Yes, I got it.
But appropriate example might be you are organizing a cricket tournament and forming a, let us say, AOP firm. Tournament is over, this association was formed only for organizing that tournament. Once the tournament is over, association is going to be closed. Then income will be assessed in the same year, that is previous year.
Yes, sir.
Is it clear?
Yes, sir.
One more
Thank you,
point,
sir.
just I want to cover in today's session. That in case of certain incomes, which are listed here, you see 1, 2, 3, 4, 5, 6 kind of situations. And these are the situations where income is not disclosed. In that case, it will be deemed to be income of the year in which it is so detected. That means there might be, as you know, income earned in the previous year, it will assess to tax in the assessment. But how to know in which year income is earned? Okay, in this following 5 situations, it is difficult to know when income is earned. In those situations, what will happen? When it is detected, in the year in which it is detected, it will be assumed that it is the income of that year. Okay, and these are referred to the situations of undisclosed income. When SSC has not disclosed, but income tax department has found out in some other way, maybe through investigation or through search and seizure, it has found out. For example, if SSC is saying he has borrowed some money or repaid some money through hundi. Okay, hundi here means you can say some unorganized, unstructured promissory note. It is something like a cash transaction. SSC is saying he has borrowed or paid that money without, not through banking channel. In that case, that income, that undisclosed income will be considered as the income of the year in which it is so detected. Similarly, if there is some unexplained expenditure, SSC has incurred some expenditure but unable to explain the source, that will be treated, that expenditure will be treated as an income in the previous year when it is so detected. Similarly, if there is some undisclosed investment, SSC has made some investment but has not disclosed, but department has detected it, then that is the income of the year in which it is so detected. Then unexplained money. Assessee is found to be in possession of some money. Then that money will be considered as the income of the previous year in which it is so detected. Then unexplained investment I covered again. Then cash credit. Okay, so assessee is found to have some either borrowed some cash or given some cash, or in the books of account it is found some cash transactions. So those incomes will be assessed to tax. That will be considered as the income of the previous year in which it is so detected. Income of the year in which it is so detected. So these are the situations of undisclosed income or income from undisclosed sources that will be considered as income of the year in which they are detected. Understood this?
Yes, sir.
Okay, so with this fairly, we have completed a particular portion. Next session, we will plan to learn about rate and rates of tax. Okay, so we are going to close our session here. Thank you very much.
Thank you, sir.